Hey, this is Robert Weinberg, your mortgage advisor and financial coach. I want to talk about the different factors that go into determining your mortgage interest rate. In the last few weeks, I've had a few clients ask me, and they've said, Rob, my friend got a 4.8% interest rate, and you're showing me a 5% interest rate. Why is my rate higher? And conversely, my friend got a 5% interest rate. You're showing me an interest rate at 4.5%. Why is my rate lower? So I wanted to do this video to talk about the main factors that go into determining what your mortgage interest rate will be. The first one, and the one that most people realize, is credit score. So lenders go based off of risk, and they price the loans based off of risk. So somebody with a 750 credit score is a lower risk than someone with a 650 credit score. So they're going to get a better interest rate based on that. And most lenders have different buckets that they'll go into to determine the interest rate. So that could be 580 to 600 is one bucket, 600 to 620 is another bucket, etc. And then typically the highest bucket is at 740. So if you have a 740 or better credit score, you're typically, based on that factor alone, going to qualify for the best interest rate. The next one to discuss is home location. Many people don't realize that the location of the property that you're buying or refinancing does have an impact on the mortgage interest rate that you're going to be offered. So certain states have higher default rates than others, and mortgage lenders track and analyze this. And there are certain states that have a hit to the interest rate or a hit to the cost to get the interest rate based on where the property is that you're purchasing. The next one to discuss is the home price and the loan amount. So the home price is affected by the loan amount because typically you're going to put a percentage down based on that home price, and the loan amount is how lenders are going to price your loan. So if you're buying a house, let's say for $100,000 and you're putting 20% down, you're only going to need a mortgage for $80,000. Well, with lenders looking at the profitability of the loans, typically loans under $100,000 are going to have an additional cost associated with them. On the other hand, loans that are considered jumbo, depending on your area, that could be $500,000, $600,000 or more, those are also going to have a hit to the interest rate. Typically, the sweet spot where you're not going to have a hit to the interest rate is going to be loans that are over $100,000 and less than $450,000, relatively speaking. The down payment and the amount of equity that you have in the home is also going to be a major factor when it comes to determining your interest rate. So somebody that's putting a 30% down payment is going to typically get a better interest rate than someone who's only putting a 5% down payment. Again, it goes back to risk. The more skin you have in the game, the more equity you have in the property, the less risk to the lender, and the better interest rate you're going to be able to get. The loan term. This is going to be the amount of time that you're going to pay the loan back contractually. So there are different loan terms, a 10-year, 20-year, 30-year, 15-year, etc. Typically, the longer the loan term is, the higher the interest rate is going to be. So a 15-year mortgage is going to have a lower interest rate than a 20-year mortgage, which is typically going to have a lower interest rate than a 30-year mortgage. Again, it goes back to risk, and typically someone that's taking on a shorter-term mortgage is going to be in a better financial situation than somebody that's taking a longer-term mortgage based on their monthly payment. Interest rate type. So typically a fixed rate is going to have a higher interest rate than an adjustable rate. And when we look at adjustable rates more specifically, there are different types of adjustable rates. So a 3-year ARM is going to have a better interest rate than a 5-year ARM, is going to have a better interest rate than a 7-year ARM. ARM stands for adjustable rate mortgage. So within that adjustable rate, the shorter term that you're going to have on that, the shorter fixed term, I should say, the lower the interest rate's going to go. Right now, typically the 5 and 7-year ARMs are going to be a good bet as far as getting a good bang for your buck on the interest rate versus a 30-year fixed, if that's something that you're interested in. The loan type. So all the different loan types that are out there are going to have completely different interest rate tables. So FHA loans, VA loans, conventional, they all have different interest rates. They may be similar, but typically they're factoring completely different things in their pricing models. So for example, a USDA loan is going to have a completely different interest rate table than an FHA loan or a conventional loan. Same with a jumbo loan, or as I've talked about in some of my other videos, non-QM loans, which stands for non-qualified mortgage. Those are completely different interest rate factors and tables than the other loan types. So you need to take into consideration the type of loan that you're applying for and realize that that may determine the actual interest rate that you're qualifying for. And last but not least is occupancy. So going back to talking about risk, The lowest risk loan is going to be a primary residence. So that's a residence where you actually live there full time and it's your primary home. The second lowest risk is going to be a second or vacation home. So that would be a home that you would reside in part of the year as a second or vacation property. And then the riskiest of all loans, which is going to have the highest interest rate, is going to be an investment property. This is a property that you're buying strictly for investment, to rent out and collect rental income, and that's going to represent the highest risk to the lender. So based on those three different occupancy types, that's going to determine your level of risk and the actual interest rate that you qualify for. So hopefully after seeing all these factors, there actually are some others that I didn't even mention here, but these are the most common factors that go into the interest rate. So you can see one size does not fit all when you're actually getting a mortgage and getting an interest rate quoted. It's very important if you see rates online or advertised anywhere, you read the fine print, because typically those rates will not apply to you. They're very high credit score, very high down payment. They might be on a conventional loan, but you're interested in an FHA loan. They might be on a non-QM loan when you're interested in a jumbo loan. There's all these different factors that come into play. So it's important you realize that there are all these different things that determine your actual mortgage interest rate. As always, it's important to get with a mortgage advisor as early in the process as possible when buying or refinancing, so you can determine the different loan types you're eligible for and what may be your best bet as far as getting the best interest rate for your particular situation. If I can be of assistance, as always, you can reach out to my office via social media, or you can call or text me directly at 860-413-3938. We'll talk to you soon.